Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'll be reporting flows for the week ended Wednesday, January 27th, 2016. Mutual fund investors actually added about $6.6 billion to the coffers of mutual funds, but the headline numbers are a little bit misleading. You know, generally we had kind of an up and down type of week that we went through. We heard that the oil prices went up, and in tandem, sort of the equity markets. Then we had some discouraging news about oil prices again. They went down. And of course, in that background, we saw the Fed actually come out and not do anything with interest rates, but basically kind of left the door open for future interest rate increases as soon as March, even though they said the economy was kind of punkish and all. So really, as we were taking a look at this, earnings were good, the economy was good, and we actually had our first positive week of upside performance. The Dow Jones actually was up about 1.13%, and the S&P 500 was up about 1.28% Wednesday to Wednesday. So it was kind of an intriguing number. But like I said, the numbers are a little misleading. Let's take a look at our macro groups to see how it all panned out for mutual funds. Equity funds saw about $5.1 billion in outflows. That's part of the story I was telling you about. Taxable bond funds actually saw about $2.6 billion in outflows. And the only bright cloud in the sky as far as those type of securities goes, muni bond funds again took in money about $0.5 billion. But money market funds, this is what the story was. Money market funds actually saw about $13.9 billion in net new money coming to their coffers. And that's why we saw the positive inflows for the week. Well, let's do a macro group by macro group breakout and take a look at equity funds first. For the equity fund arena, we saw a 1.81% return for equity funds. It's the first week in 5 we saw positive returns, but mutual funds do not turn on a dime, and neither do the investors that are investing into them. So we saw continued outflows, $5.1 billion in outflows, fourth consecutive week we've seen outflows. And how this broke out, domestic equity funds for the 12th consecutive week actually lost $4.9 billion, and non-domestic funds for the first week in 3 actually saw outflows as well. That was about $200 million in outflows. And how that broke out, if we take a look at the domestic equity funds, large cap funds and equity income funds lost money, $2.3 billion for large caps and about $1 billion for equity income. And then we take a look on the non-domestic side, and we see that international equity funds actually had about $1 billion in inflows. But global, that has a little bit of a U.S. connotation in there. Global equity funds lost about $1.2 billion. Well, let's take our look now at the ETF arena. ETF arena was really quite different. It is the first week in 4 that we actually have seen inflows, and it was about $3.9 billion in new money coming into their group. But at the top was kind of a mix of very broad-based names. S&P 500, the SPY, saw about $3.5 billion new money coming to their coffers. The iShares Russell 2000, so even people going after small caps, $2.7 billion. And this is kind of where the unique piece is. We saw oil going up, small caps maybe responded a little bit. They've been getting beat up recently. And of course, SPY was kind of that safety play. But at the bottom, if we take a look at it, iShares Russell 1000, growth, and the growth have taken a little bit of a spanking here recently, about $700 million in outflows, and the iShares MSCI emerging market emerging market funds saw about $600 million in outflows. So really kind of a tale of two cities here. We see the authorized participants were willing to put risk on the table, and they were really kind of paying attention to what oil was doing, what the earnings reports were doing, and really what the economy was doing. And I think it was really quite ho-hum what the Fed came out. That's what they expected. Let's turn our attention to fixed income funds now. Fixed income funds for the 12th consecutive week saw outflows, $2.6 billion this time. It's the first week in 5, though. We've seen plus side returns, 0.62%. And at the top of the group, taking in money, is government mortgage funds. About $600 million came into that group. And actually, there was other treasuries that are a little bit smaller. And it's the 24th and 25th week that we've seen mortgages take in money. At the bottom of the barrel was corporate investment grade debt funds. They saw about $2.1 billion in net outflows. So certainly, this was kind of one of those stories where we did see a little bit of flight to safety. And you got to remember, authorized participants aren't necessarily going to do the flight to safety themselves, but they were setting it up for ETF investors to come in and actually have some inventory. So that might have been part of it. And some of it could have been just hiding for themselves, just a place to park for a couple of days until they get the feeling of what the Fed finally was going to do. As we know, they didn't raise interest rates, but they made their statement, and then they went back to work, and we've seen some pretty good market returns here recently. Now let's take a look at the ETF side of the arena, and it's $5.9 billion in net new money coming in. It's the third consecutive week that we've seen inflows into ETFs. And then as we take a look at this, the iShares Treasury Bond Fund, this is a short treasury, they actually saw about $1.9 billion of new money come into their group. And then The iShares iBox high yield corporate actually took the next biggest inflows, $808 million. Now, this is that idea that a lot of the high yield funds were getting spanked because of oil, and we saw a nice little rebound in oil, and I think investors said, hey, listen, maybe there's a little bit of overselling here, and they took that opportunity to weigh in there. Let's take a look actually at the bottom now, and that's iShares mortgage-backed securities ETF. Well, there's a dichotomy, right? We saw that the non-ETF investors were putting money to work in mortgage backs, and in this case, ETF investors actually were walking away $185 million. That's all in outflows. Not that big of a deal. Let's take a look at the kind of shining light we were talking about, and that's muni bond funds. Muni bond funds actually for the 17th consecutive week saw inflows. $502 million. Not the biggest, but again, we've been doing 5, 6, 7, 5, 6, 7. I think the moving average is right around 6 something. It's actually been good couple of weeks for inflows for muni bond funds. Obviously, there's tax implications there, but I think people have been evaluating the actual after-tax returns, and that's been very positive. First week in six that we've actually seen a negative return, though, 0.14% on the minus side. And if we take a look at the breakout, national munis actually saw the biggest inflows, 456, and so a little bit went to single states. Certainly the trend we've been seeing, people flocking more towards national, flocking away from the single states. Maybe it's just a risk focus and they want to put a little bit more diversification in their portfolio. We'll have to see what the pattern actually continues to do going forward. Well, let's take a look at our last group. That's money market funds. Money market funds for the second week in 3 basically saw inflows $13.9 billion in net new money coming to the group, and it was really kind of a lopsided a piece here. When we take a look at taxable money market funds, saw $20.2 billion in net new money come into their group. Institutional investors accounted for $13.7 billion of that net new money, and retail investors 6.5. So how do we get to 13.9? Tax-exempt money market funds, people putting money back to work, probably in munis and other areas as well, $6.3 billion in outflows. Well, that certainly brings us to the end of our discussion on flows here this week. But there's a couple things that came out just recently that bears in mind. That's certainly we had durable goods orders that was out there, and it was a little bit down. It was like a 0.7. I think people expected durable goods orders to come in about 0.8. So not that bad. It's plow horse economy, as our friends at First Trust talk about. Certainly that stayed in there. And then we had the last piece, the GDP. Growth. Actually, GDP growth came in at 0.7%, and that would also support that plow horse economy that First Trust often calls it. One thing that we're going to keep our eyes on, obviously, is going to be earnings report. We're right in the middle of earnings report season. Actually, it's been some good numbers that have come out recently, and of course, our eyes will be on oil. Well, if you want to do a deeper dive and check out what your favorite classification or macro group is, and find out what the flows are, please go to our site www.lipperusfundflows.com, or just come and visit us next week. We'll run up analysts to talk about the flows trends for that week. Well, until next time, my name is Tom Rosine, wishing you the best in your wealth planning and creation.